Last week, the AI sector saw a sharp pullback, and one company was at the center of it: Oracle. They reported earnings that looked impressive at first glance, but the market's reaction told a very different story. Oracle's stock dropped hard right after the results came out, and that weakness spread across other AI-related names as investors started to question how solid this entire AI boom really is. In this video, I'm breaking down what Oracle reported, why Wall Street responded the way it did, and what this could mean for the AI trade going forward. First, let's look at what actually happened before we move into the deeper numbers and guidance. Oracle delivered a strong Q2 2026 on paper, with EPS of $2.26, beating expectations by almost 38% and rising 51% year-over-year. Revenue came in at $16.1 billion, up 13%, though it missed forecasts by a small margin. Cloud was the clear standout. Total cloud revenue hit $8 billion, up 33%, with infrastructure revenue up 66% and GPU-related revenue soaring 177%. Oracle's remaining performance obligations surged to $523 billion, driven largely by AI infrastructure deals with companies like Meta and NVIDIA. Despite strong growth, free cash flow was negative $10 billion because of massive capital spending. Oracle invested around $12 billion this quarter to expand its AI data center footprint. Executives said most of that spending directly supports revenue-producing infrastructure, and noted that Oracle can use flexible financing models, like customer-provided hardware or vendor leasing. They also expect these investments to generate an additional $4 billion in revenue in fiscal 2027 as new capacity comes online. Oracle outlined an aggressive AI roadmap, expanding its AI data platform, integrating top AI models across its cloud ecosystem, and making Oracle Database and its applications fully accessible to AI agents. Multi-cloud adoption is accelerating too, with Oracle operating 147 regions and planning many more. Partnerships with Google, OpenAI, xAI, Broadcom, and Palo Alto Networks are fueling marketplace growth. On the applications side, performance was solid, up 11%, driven by strong momentum in Fusion ERP, SCM, HCM, and industry cloud suites. Oracle highlighted its shift toward One Oracle, which unifies sales teams and supports larger, multi-product deals. Executives said built-in AI features and industry-specific AI agents are helping drive adoption throughout the software lineup. For Q3, Oracle is guiding for cloud revenue growth of 37 to 41% in constant currency, and EPS growth of 12 to 14%. Management kept emphasizing that Oracle is positioning itself as a core AI infrastructure provider with improving profitability once new capacity scales. In short, Oracle posted strong earnings and explosive cloud growth, but massive AI infrastructure spending and a slight revenue miss fueled investor concerns, even as the company positions itself as a major player in enterprise AI. Oracle's stock dropped because investors focused less on the earnings beat and more on the warning signs around profitability and cash flow. The biggest issue was the $12 billion of capital spending needed to support data center growth, which pushed free cash flow deep into negative territory. That's a significant cash burn, and it signals that Oracle may need to continue spending heavily to keep up with AI demand. Revenue also came in just below expectations, which suggested that not all parts of the business are growing as quickly as investors hoped. And while cloud is expanding rapidly, Wall Street wanted a cleaner beat across the board from a company now positioning itself as a top-tier AI infrastructure provider. Guidance also contributed to the reaction. Even with a massive backlog of over $500 billion, Oracle didn't raise full-year revenue targets. That made analysts question how quickly those big AI contracts can actually be turned into revenue. Finally, the sheer scale of Oracle's AI build-out created uncertainty. The level of spending required raises questions about debt, the timeline for returns, and how long investors will tolerate negative cash flow in the name of future growth. So the stock dropped because the report raised concerns about cash burn, heavy spending, softer than expected revenue momentum, and uncertainty around how fast AI investments will pay off, even though the earnings beat looked great on paper. And this brings me to my main concern with Oracle. They're growing fast in AI infrastructure, but that growth depends on massive spending and nonstop data center construction. Eventually, either financing becomes too expensive or demand cools off. And when that happens, the revenue engine slows. If they can't keep building, they can't keep growing. And that's exactly the risk the market is starting to price in. For me, that's why I don't see Oracle as a buy right now. The AI narrative is exciting, but it comes with huge financial pressure, and at some point those lines cross. Thanks for watching. If you found this breakdown helpful, make sure to like the video and subscribe to the channel for more earnings analysis and market insights. I'll be covering more major companies and market-moving stories soon, so stay tuned, and I'll see you in the next video.